Every major financial crash in the last 100 years has followed the same pattern. Not similar patterns, the same pattern. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. This is a 5-stage sequence that appears months, sometimes years, before the collapse actually happens. Wall Street knows about this pattern. The Federal Reserve knows about it. The people who manage money for billionaires definitely know about it. But you've probably never heard of it, because if regular people understood what to look for, they'd pull their money out before the crash instead of after. Welcome to falling value. Today, I'm going to walk you through all 5 stages, and I'm going to show you exactly where we are in that sequence right now. Spoiler, we're further along than you think. Roger Babson and 9 words. In 1929, a man named Roger Babson gave a speech at a business conference. He said 9 words that made him the most hated man on Wall Street. Sooner or later, a crash is coming and it may be terrific. The audience laughed. Newspapers mocked him. Irving Fisher, the most celebrated economist of the era, dismissed him publicly, declaring that stocks had reached a permanently high plateau. 47 days later, the market collapsed. Fisher lost everything. He died in poverty. Babson made a fortune and went on to found a college that still exists today. But here's what most people don't know. Babson wasn't guessing. He had developed a systematic method for analyzing financial conditions. He looked at credit levels, market concentration, institutional behavior, liquidity conditions, and what he called trigger vulnerabilities. 5 factors, 5 stages. I spent 3 months going through historical records, Federal Reserve data, and academic papers to verify whether his framework actually held up across different crashes. It does every single time. Let me show you. Stage 1 is the credit explosion. This is where it always starts. Not with greed, not with speculation, with debt. Before every major crash, there's a period where credit expands faster than the economy can absorb it. People borrow money they can't afford to repay. They use that borrowed money to buy assets. The buying pushes prices up. Rising prices make people feel wealthy. Feeling wealthy makes them borrow more. It's a feedback loop that feels like prosperity, but it's actually a trap being set. In the late 1920s, margin debt exploded. Ordinary Americans were putting down 10% and borrowing 90% to buy stocks. By 1929, total margin debt equaled the entire federal budget. Factory workers were leveraged like hedge funds. In 2007, it was mortgage debt. Banks created exotic instruments that let people buy homes with no money down. They packaged those mortgages into securities and sold them to pension funds. The leverage was hidden, but it was everywhere. In 2000, it was corporate debt. Companies with no profits borrowed billions to fund expansion. They used stock as collateral. When stock prices fell, the whole structure imploded. Now look at where we are today. Official margin debt sits around $750 billion. But that number is a lie. It only captures a fraction of the actual leverage in the system. Add in securities-based lending, where wealthy investors borrow against their portfolios, and you add another $800 billion. Add in the leverage embedded in options markets, where a small amount of money can control massive positions, and you add trillions more in notional exposure. Add in corporate debt, which has exploded to over $10 trillion. Much of it used to buy back stock rather than build businesses. Add in government debt, which has crossed $34 trillion and requires interest payments larger than the defense budget. As a percentage of GDP, total debt in the American economy is now higher than it was in 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't just flashing red, it's on fire. Stage 2 is the concentration trap. Here's something they don't teach you in finance class. Crashes don't just happen because prices are high. They happen because risk is concentrated. When a small number of assets carry a disproportionate share of the market's value, the system becomes fragile. All it takes is one of those assets to stumble and it drags everything else down with it. In 1929, the market was dominated by a handful of glamour stocks. Radio Corporation of America was the superstar. It went from under $2 to over $500 in a few years. People didn't understand radio technology, they just knew the stock kept going up. RCA made up a huge percentage of the market's value. When it cracked, the whole market cracked with it. In 2000, it was the dot-coms. Cisco, Intel, Microsoft, a handful of tech names. The NASDAQ was essentially a bet on 10 companies. When those 10 rolled over, trillions in wealth vanished. In 2008, concentration was hidden in the banking sector. 5 banks held the majority of derivatives exposure. When Lehman went down, it nearly took the whole system with it. Today, the concentration is staring us in the face, and somehow nobody seems concerned. The top 7 stocks in the S&P 500 now account for over 30% of the entire index. At certain points this year, it's been closer to 35%. Think about what that means. When you buy an S&P 500 index fund, which is what sits in most retirement accounts, you're not really buying 500 companies. You're making a massive leverage bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the thing about those 7 stocks. They're all trading at valuations that require perfection. Not good earnings, perfect earnings. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has made this worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks, pushing their prices higher and increasing their weighting. This is a momentum machine that works beautifully on the way up, and on the way down, it reverses. Every dollar that flows out sells the biggest positions first. Forced selling creates more selling. This is stage 2, the concentration trap. And we're deeper in it than we've ever been. Stage 3 is the smart money exit. This is the stage that makes me angriest because it reveals how the game actually works. Before every major crash, there's a period where institutional investors, banks, hedge funds, and billionaires quietly reduce their exposure. They sell their positions, they raise cash, they buy protection, they don't announce it, they don't warn anyone. In fact, their public statements often say the opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic. And while they're saying that, they're heading for the exits. In 1929, the Morgans and the Rockefellers started liquidating in the summer, months before the October crash. Bernard Baruch, one of the richest men in America, was almost entirely in cash by September. Joseph Kennedy sold everything after his famous shoe shine boy conversation, but the real reason he sold was that he had connections to people who knew what was happening inside the banks. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs famously bet against the same securities they were selling to clients. Executives at mortgage lenders were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. Now let's look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, and board members are selling their stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. Meanwhile, retail investors, regular people continue to pour money into the market. Robinhood accounts, retirement contributions, and passive index flows are at record amounts. The smart money is selling, regular people are buying. This is not a coincidence. This is the pattern. It works this way every single time. Stage 3 is flashing a red alert. Stage 4 is the liquidity illusion. This is the sneakiest stage because everything still looks normal. Prices might be stable or even rising. Trading volumes are healthy. Nothing seems wrong. However, underneath the surface, the liquidity supporting the market is draining away. Liquidity is like oxygen for financial markets. When there is plenty of it, everything functions smoothly. Buyers and sellers can transact easily. Prices adjust gradually. Shocks are absorbed. When liquidity disappears, markets lose their function. Prices do not adjust gradually. They fall by leaving gaps. Small sell orders move prices by massive amounts. Feedback loops take over. The crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool down speculation. In fact, what they were doing was drying up the liquidity that supported asset prices. For a while, nothing happened. When the market continued to rise, people thought the Fed's tightening did not matter. Then October came, and when the selling started, there was no one on the other side. Buy bids vanished instantly. Stocks did not just decline, they went into a free fall because there was literally no liquidity. The same thing happened in 2007 and 2008. The Fed was raising rates, credit conditions were tightening, but the stock market stayed high. Housing prices stayed high. Everything looked good. Then Bear Stearns collapsed. Then Lehman. And suddenly, everyone realized the liquidity was gone. The market dropped 50% within months. Today, there is hidden stress. Now, look at today. The Federal Reserve has raised interest rates at the fastest pace in the last 40 years. They went from 0 to over 5% in less than 2 years. They are conducting quantitative tightening by withdrawing hundreds of billions of dollars from the financial system. And despite this, the stock market is near all-time highs. People think this means the tightening does not matter. They believe we have achieved a soft landing. They are wrong. Stress is already showing itself. In March 2023, 3 major banks failed in a single week: Silicon Valley Bank, Signature Bank, and First Republic. These were not small institutions. They collapsed because of a liquidity crisis caused by rising interest rates. The Fed had to intervene with emergency lending programs. While claiming they were not doing a bailout, they essentially printed money to support the banking system. These emergency programs are temporary patches. They do not solve the underlying problem, they only delay it. The Treasury market, the foundation of the entire global financial system, is showing signs of stress. There have been moments where liquidity in the Treasury market nearly evaporated. The most liquid market in the world is experiencing plumbing problems. This is stage 4, the liquidity illusion. On the surface, everything looks calm. Underneath, the oxygen in the room is being sucked out. And this brings us to stage 5, the trigger. This is the stage no one can predict, and that is exactly what makes it so dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market. It is the match that lights the fuse. What most people get wrong about triggers is this: they think the trigger causes the crash. It does not. The crash is caused by everything from stage 1 to stage 4: debt, concentration, the smart money exit, and the liquidity drain. These create the conditions for the collapse. The trigger only determines the timing. In 1929, the trigger was the Hatry case. Clarence Hatry was a British financier arrested for fraud in September. No one in America cared. It seemed irrelevant. However, British banks had exposure to Hatry. They needed to create cash. Therefore, they sold their American investments. This sale created more sales. Within weeks, the market was in a free fall. A small British fraud case triggered the Great Depression, not because the fraud was important, but because the system was so fragile that any shock would have done it. In 2008, the trigger was Lehman Brothers, but it could have been Bear Stearns or AIG or any other number of institutions. The system was ready to explode. Lehman was just the spark. What will happen this time? Well, what will be the trigger this time? I do not know. No one knows. That is the nature of triggers. It could be geopolitical, a real escalation in Taiwan, something unexpected in the Middle East, or a miscalculation with Russia. It could be financial, a major hedge fund blowing up, a sovereign debt crisis in Europe or Asia, or a derivatives accident. And remember, the derivatives market is over $600 trillion in nominal value. Something could happen in the banking system. More regional banks failing, or a run on a major institution, or a commercial real estate crisis that also takes down the lenders who financed it. It could be political, a constitutional crisis, a debt ceiling standoff gone wrong, or loss of confidence in the dollar. Or it could be something no one is talking about. It usually works this way. The trigger is never the thing everyone is worried about. It is the thing no one sees coming. What I know is this: while everywhere is flashing red from stage 1 to stage 4, the trigger usually arrives within 12 to 24 months. Since the end of 2024, 4 stages have been confirmed. This puts the window in 2025 or 2026. Let me tell you what this does not mean. I am not telling you the market will collapse tomorrow. Timing is impossible. Markets can remain irrational longer than your solvency can last. Anyone who says they know exactly when the crash will come is lying. Also, I'm not telling you to sell everything and hide in a bunker. This is not a strategy. This is panic. What I'm telling you is that the conditions before every major crash in the last 100 years are present right now. All 5 stages are either active or imminent. This is not a normal situation. This is not a drill. The question is not whether you believe me. The question is what you will do with this information. Roger Babson did not just predict the 1929 crash, he prepared for it. While everyone was in debt up to their necks, he held cash. While everyone was buying shares at the peak, he bought farmland and hard assets. When the crash came, he was positioned to survive and thrive. The genius economist Irving Fisher, who mocked Babson, lost everything: his fortune, his reputation, and his legacy. He spent the rest of his life trying to recover and never succeeded. The difference between them was not intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself according to what was coming, not what he wished would happen. You have the same choice right now. You can look at the data I just showed you and decide it does not apply to you. Or you can ask yourself some uncomfortable questions. How much of your wealth is in the stock market right now? Not just your investment account, but your retirement accounts, your salary if you have one, or the value of your home if you live in a bubble market. How much of this is concentrated in a handful of giant tech stocks? How much of your financial security depends on prices staying where they are or rising? If the market dropped 50% over the next 18 months, which is what happened in 2008, would you be okay? Would you lose your retirement? Would you have to postpone your plans by 10 years? I'm not telling you what to do. I am not a financial advisor. I am a historian. I study patterns, and the pattern is clear. People who are ruined in crashes are not stupid. They are just unprepared. They trust experts who tell them everything is fine. They believe the system is more stable than it is. They assume someone would warn them if something was really wrong. No one warned them in 1929. No one warned them in 2008. No one is going to warn you now. The warning is the pattern itself, and now you know it. What you do next is up to you. If this analysis helped you see something you had not seen before, we will continue to examine each of these 5 stages in more detail at Falling Value in the coming weeks. We analyze market conditions in real time, including specific data points you can track on your own. Knowledge is not power. Applied knowledge is power. The crash of 1929 did not have to ruin so many lives. The signals were there. The pattern was clear. People chose not to see it. Do not make the same choice. Do not forget to subscribe and turn on notifications for financial history and market analysis at Falling Value.